Hello and welcome to the Harwood Report for May 14th, 2018, presented by Trade Academy. I am Keith Harwood, your host and the founder of Trade Academy. As a reminder, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please read the remaining disclosures. They apply for what I'm talking about here. This week's highlights. As usual, I'm going to go over equity indices, the VIX, bonds, gold, oil, all the stuff I normally look at on a weekly basis, and that's kind of how I look at this macro environment. As a reminder, and I'll expand on this at the end, the Harwood Report premium newsletter will be coming out later this afternoon, and if you sign up for that, you get the first 2 weeks for free. So go to tradeacademy.co to sign up. Probably seeing this on the blog anyway. It's a good deal to get something for free, even if it's for 2 weeks. Fear and greed index, neutral. We're still seeing most of the greed coming from junk bond demand and safe haven demand. Obviously, put and call options have started to show some greed. That's not necessarily an indication that the market needs to stop, but finally starting to see a little bit less panic for puts. And we're also seeing that in the VIX, where this is staying neutral. I got to be honest, the way the VIX has fallen here, I think it's showing a little bit of greed. This may not be extreme fear. I think all in all, this is neutral, but I think some of the individual measures are a little off. In terms of the way that they're calculated, because they're calculated, I think, by a formula, and sometimes the human eye can give a better indication of what's going on in the market than the formula. Speaking of the human eye, let's get straight to the charts. SPY took out the 100-day moving average. We're on day 3 of the break above the 100-day moving average. Notice that we took out the high from the last time we tried to take out the 100-day moving average. We're above the 10, the 20, the 50, the 100, and the 200-day moving average for the first time since March 15th. So it took a couple months. We got rid of some shop here between the 200 and the 100-day moving average. Now it seems like we may be getting back into a little bit of a grind higher mode. I think some of these moving averages may need to catch up, but that doesn't mean that we're not going to 280 plus. My thesis at this point is that this is probably going to happen. Seeing these moving averages starting to steepen and catch up does set up that nice trend higher move. I like to see the 10 above the 20, above the 50, above the 100, above the 200 when we're getting a trend higher. When we're kind of got all these moving averages below here, it tells me that everybody that's bought in the last any period basically is making money. The average buyer over the last 10 days was down here, 267. But people like to see those slopes higher and keep the shortest term momentum above the rest of the moving averages, so you don't have big institutional money that may be keying off the 200-day moving average, offsetting people that are in based upon shorter term signals. The other thing that we're seeing here is that the VIX has been leading this market run. So where the VIX is right now is low. It touched down to 1265 on Friday. On the February crash, and since the February crash, the low has really been right around there, around a little over 13. That was on those March highs last time we got above all the key moving averages. This crash, really, the market crash, which was partially driven by some VIX issues, and I talked about that in prior weeks. What happened with XIV, what happened with SVXY, these blow-ups of products helped create fear to the marketplace. At the end of the day, though, the fundamentals weren't necessarily all that bearish. We had some spikes up here with things like Chinese tariffs and what's going on with Iran and what's going on with North Korea. But all of that seems to be getting back into the background as the market calms back down and seems to want to return to the normal, what I'll call the normalcy of 2017. Not that 2017 was at all normal, but that presses VIX down, maybe down to 10.5, 11 over time. Are we going to crash there in a day or two? I don't think that the VIX wants to drop quite that fast. People will still have a little bit of a memory of a 45, 50 VIX. So they're not going to want to let it happen, where we get back to the lows here around 9. But the market's telling us that there's less to be afraid of right now. And that's part of why we've rallied out of this and rallied without much slowdown this time. So now what? That's the question. Well, if we get a lower high and a lower low, right now we keep doing higher highs and higher lows. If we get a lower high and a lower low, I look towards a potential pullback trade. What's a pullback? I think we got to only target the 10-day moving average, the short-term pullback. As long as we continue higher high and higher low, I can play for move towards 280 over time. If I look at where SPY is, and I know that vol is generally cheap here, I can look at this term structure and say, gosh, I can buy sub 10 vol if I go to the end of this month, or right at 10% vol. That's pretty darn cheap. So for me, means, all right, I go to the end of the month, I look at some May 29th options, and I say, gosh, if we're going to do this by the end of the month and get to 280, the market's only pricing in about a 4.25 straddle, so that's 277.5, 277.25. You know, something like these 76 calls, maybe worth $4 on a move to 280. That seems pretty interesting. And if I want to hedge this in the short term, which I may want to, I can just go all the way back to this week and look at just turning this into a calendar or a diagonal. For this case, I'll just do it as a calendar. And the idea is as follows. Very simply put, the delta on these options is sub 20. It tells me that there's a lower probability we get through 276. We've already had a lot of money flow to get us to this point. This calendar is 61 cents, and 276 right here is kind of near the highs. I just think that this is, if this market's going to slow down a little bit, this plays really well. And if it takes off quickly, now this still should pay because it's got a long delta to it. So the goal out of this is to have a grind higher and ultimately end the month close to 280. That's the perfect scenario for this trade. That's kind of my thesis right now. So that's kind of how I'm looking at this. Calls for it's now 59 cents. So I'll look at this as a 59-cent calendar. It looks intriguing to me as a way to play for that eventual upside. That may be a grinding higher mode. Let me go over to the other indices. So we've got IWM. Small caps. Made a new high today. 160.68. The January high was 160.62. So touched it, pulled back. You know, that's not the greatest sign to see that much of a pullback, but at the end of the day, still made a new all-time high. Nothing's bearish about a new all-time high, right? Sure. You know, a new all-time high tends to follow some selling if it doesn't hold. But how am I going to do? I'm not going to predict that on day one. Again, I'm thinking about that potential for a pullback to the 10-day moving average. And if that doesn't hold, that's potentially a problem. But as long as it holds, you know, we a number of times made new all-time highs, pulled back to the 10 or even the 20-day moving average and then rallied. And this is a scenario where the 10s above the 20s, above the 50s, above the 100s, above the 200. All signs point to strength in small caps. We'll talk more about specific trade examples there, or trade ideas there in the premium product. The Qs, today's high, 170.81. The January high, 170.95, didn't quite take it out. The February high, 170.73, did not quite take it out. Oh, sorry, it did take that out. And then, of course, the all-time high in March, above 175. That's a little ways away. We're basically, you know, shopping around that consolidation area. Tech has been the leader for the market over the last year and change. I don't know that it has to be the leader this time, but it's something to just watch. I think this is setting up still bullish, and you can see that the Qs has barely even retested back to Friday's highs after opening very firm this morning because semiconductors were firm this morning. Everything going on with China seems to be loosening up a little bit for semiconductors, and you can see semiconductors are still having a very good day with a light pullback from highs. So generally speaking, I'll reiterate, I tend towards the bullish side, but concerned about like the pullback that I'm worried about is back to the 10-day moving average. And if the 10-day moving average doesn't hold, then I got to start worrying, or we get a lower high, lower low, and that seems to get follow through for 2 days in a row. Right now, TLT is just not doing anything. I have some ways to trade a not doing anything market. There is opportunity in TLT. It's vol focused, not necessarily directionally focused. You can see that it's just doing the same sort of stuff it did back here in February. Just, you know, it seems like almost nothing happening here right now. So it's a boring market. There are ways to profit off of a boring market, even while taking relatively good defined risk. So I'll talk about that in the premium product instead, and just move straight over to gold for the sake of time. Dollar yen continues to be strong with a little bit of consolidation over the last week and a half. GLD was weak, but bounced off of those lows. Maybe they got a little overdone here down to the 200-day moving average and bouncing. But overall, this is looking like it could be a bearish setup as the dollar continues to show some good strength, even with a little consolidation. The dollar on the whole is a little bit weak today. It's not necessarily a bad thing for gold. It could be a neutral thing for gold because the yen is still my focus. So if I see the yen today, higher high, higher low, that 110 level is going to be important, a little bit above 110 there where the 200-day moving average is 110 and 19. But generally speaking, as long as this pullback just creates a little consolidation, that's just basically a bull pennant. You can see it's just tightening the wedge, and then the next move higher potentially sets up a big break for GLD, and that would be the 200-day moving average. So when I look at GLD, I can see here that 125. If I'm looking bearish, I want to play for the break below 123.5, and then that really sets us up for this move down towards 121.5, that consolidation area in November and December. So let's look and see if the options are giving me an opportunity here. Uncheck positions only so that I've got them all. Oh, come on. There we go. Let's pull up a chart. And we can see that vol in GLD is pretty darn cheap. Rarely gets below about 9.25%. Right now it's at 9.5. And the downside's cheap as well. Now when I look at June 1st, on the downside, I'm in the 8s. It's ridiculous. So 123.5 was that first test zone. That's the inflection point. If I've got 2 weeks to get below 123.5, I can make a lot of money on the way there. And simply put, with vol this cheap, I don't mind taking an outright shot here. June 1st, 123.5 puts for 40 cents are cheap. That's the way I'm looking to play the gold story right now. Silver is similar, but had a little bit bigger of a rally here. We're really in the middle of this consolidation zone. I think that silver will be the second to break, so it'll be kind of a follow-on to gold. That means that if I miss the gold trade, I'll turn my focus to silver. Miners are actually very, very correlated to silver, and you can see that they're actually performing well even relative to silver, not trading that consolidation area as much. And GDXJ as well, same idea. So I think that if I miss gold, I got to look to the miners and silver. Miners I like better just because they're more directly correlated to gold, obviously. Silver, though, does trade well with gold. So, all these things give opportunities, and I'll talk more about some of the other opportunities, again, in the newsletter later today. I do want to finish up with the oil names. And for the sake of time, we'll get straight into the obvious here. Oil is still near the highs. It's not looking bad at all. OIH is still near the highs. Not looking bad at all. XLE is still today actually making a new high. This is the key. 78.39. Today's high, 77.59. When I'm this close to the high, I can wait. So if it takes out 78.39, I'm looking for XLE calls. Because that may happen faster, and because OIH vol is cheaper on a relative basis, I will look for OIH as instead. So you can see OIH vol is about as cheap as it's been in the last 6 months, 25%. If XLE takes out the previous highs, OIH is going to be a natural follower. Go to June 15th, 30 calls for 26 cents. That's where I go here. It's just going into the June 15th. That gives me a lot of time in case there's a little bit more chop in oil. But if oil makes a new high and XLE makes a new high, OIH can pick up even more momentum than it already has. And remember, the previous high in OIH is right here at 29.53. So this is fully playing for that breakout. But I expect to see it happen in XLE first and OIH second. So again, XLE is an interesting way to play that, but OIH has that greater squeeze kind of potential. That makes those June 30 calls a little bit more exciting for me. And so that's where I'm looking to play. All right, that's it as a roundup for today. And as I mentioned earlier, the Harwood Report has a premium element. I have a newsletter that I'll be putting out in a little bit today, and also more videos in the middle of the week. And I talk about why I'm looking at different structures as well, and I talk a little bit more about what's going on in all these markets. So if you sign up now, you get your first 2 weeks for free. A lot more trade ideas that I'm looking at, as well as a lot more informational content. Go to tradeacademy.co/Harwood Report to sign up. And then if you enjoy what you're seeing, it's $49 a month after that, still cheap. And if you don't, you get your 2 weeks for free and move on. You can always email me, Keith@tradeacademy.co with comments or questions, or call me 312-600-8004. Thanks again, folks, and I'll talk to you soon. Have a great afternoon.